you have been told a lie about the roof over your head. Every time your lease comes up for renewal and you see that painful rent increase, the explanation is always the same. It is just basic economics, they say. It is the simple law of supply and demand. Too many people want to live in your city, and there are not enough apartments to go around. If we just build more housing, the prices will eventually come down. It sounds logical, like something you would learn in a high school economics class. But it is fundamentally false. The reason your rent is so high, and the reason it is never going to come down in any meaningful way, has absolutely nothing to do with supply and demand. The housing market as you understand it no longer exists. It has been entirely replaced by a complex, high-stakes financial machine, and you are not the customer. You are simply the battery powering it. Housing is no longer a human necessity. It has been transformed into a purely financial asset optimized for one single purpose: servicing massive amounts of corporate debt. If rent prices were ever allowed to significantly fall, it would not just mean a break for your wallet. It would threaten the stability of the entire global financial system. To understand how we ended up in this inescapable trap, we have to look back at the ashes of the 2008 financial crisis, when millions of hardworking people lost their homes to foreclosure. A massive void was created in the real estate market. But those houses did not simply vanish, and they were not bought up by other regular families. Instead, large institutional investors, private equity firms, and Wall Street giants saw an unprecedented opportunity. They swooped in with billions of dollars and bought up massive portfolios of distressed properties. But their goal was never to flip these houses and sell them back to families. They turned these properties into permanent rental units. This was the birth of the massive financialization of housing. We moved from a market dominated by individual homeowners and mom-and-pop landlords to a landscape controlled by massive corporate entities. In certain zip codes across the country right now, institutional ownership of rental properties wildly exceeds 30%. When massive corporations own a third of the available housing in a neighborhood, they no longer have to compete for your business. They become the market makers. They dictate the terms of reality. And this shift laid the groundwork for the nightmare we are living in. But buying up properties was only the first step. To truly extract maximum wealth from renters, these corporations needed a way to eliminate competition altogether. Enter algorithmic pricing. In the old days, if a landlord had a vacant apartment, they were losing money every single month it sat empty. To get someone in the door, they would lower the rent, offer a free month, or negotiate. That is actual supply and demand at work. Today, that dynamic has been completely eradicated by software platforms like RealPage. Instead of competing against one another, property managers across entire cities plug their private inventory and pricing data into a centralized software system. The algorithm crunches the numbers and tells every single landlord exactly what to charge to maximize absolute revenue. It essentially functions as a massive price-fixing cartel. The software actually encourages landlords to leave apartments completely empty rather than lower the rent. The algorithm has calculated that holding a unit vacant is more profitable than breaking the price floor because keeping the rent artificially high on the occupied units makes up for the loss of the empty one. You are fighting against a cold, calculating machine that coordinates rent increases across competing properties, making true competitive pricing mathematically impossible. Now, you might be thinking, if everyone is struggling to pay, eventually the bubble has to burst, right? Eventually, these corporations will have to lower prices or face a mass revolt. This is where the most terrifying aspect of the modern housing market comes into play: the debt service floor. This is the unbreakable barrier that guarantees your rent will never decrease. When these institutional investors purchase sprawling apartment complexes, they do not buy them with straight cash. They buy them with staggering amounts of highly leveraged corporate debt. Let us say an investment firm buys a building for $100 million, mostly financed through massive loans. Those loans come with massive monthly interest payments. The property is not just a building where people live. It is financial collateral. The rent collected from the tenants is the sole revenue stream used to pay the interest on that massive debt. This creates an absolute floor for rent prices. The properties literally require constantly rising rents just to cover the ever-increasing cost of the debt service. If rent growth stalls, or worse, if rent actually starts to fall, the revenue is no longer sufficient to pay the bank. If they cannot pay the bank, the investors face catastrophic default. The the building gets repossessed, the asset value plummets, and billions of dollars evaporate overnight. Because so much of the global financial system is heavily invested in these real estate-backed assets, allowing rent to drop is not just bad for the landlord, it is a systemic threat to the banks, the pension funds, and the entire global economy. The system is aggressively designed to defend this price floor at absolutely all costs. The government, the banks, and the investors will do everything in their power to ensure that the crushing burden of this debt is passed down directly to you, the renter. You are paying the interest on their massive gamble. Your stagnant wages and shrinking disposable income are the collateral damage in their relentless quest to keep the financial plates spinning. They simply cannot allow rent to fall, because if it does, the underlying value of the entire asset class collapses, taking the massive banks down with it. It is a hostage situation, and your cost of living is the ransom they demand. And if you think the situation is dire now, you need to firmly brace yourself for the catastrophic pressure that is unfolding right at this very moment. We are currently staring down the barrel of an unavoidable financial reckoning. The years 2025 and 2026 were always circled in red ink on the calendars of real estate economists as the extreme danger zone. And now we are living directly through it. We are hitting what is known in the financial industry as a massive maturity wall of commercial debt. Trillions of dollars in commercial real estate loans that were taken out years ago, back when interest rates were hovering near an artificial 0%, are suddenly coming due. These investors have to refinance their loans to keep the game going. But they are not refinancing at 0% anymore. They are refinancing in an environment of significantly higher interest rates. The cost of carrying their debt has just doubled or even tripled, literally overnight. But it is not just the crushing weight of higher interest rates that is squeezing the market dry. Landlords are being hit by a devastating storm of soaring operational expenses that they are entirely determined to pass directly onto you without a second thought. Over the last few years, the cost of property insurance has skyrocketed out of control, driven by increased climate risks, natural disasters, and the sheer replacement cost of building materials. Insurance premiums for large multifamily properties have doubled or tripled in many major markets. On top of that, municipalities, desperate to plug gaping holes in their own local budgets, are aggressively pushing through massive property tax reassessments, as the theoretical paper value of these buildings has artificially inflated over the last decade. The local governments want their cut, leading to massive spikes in the tax bills for these corporate landlords. So, you have to look at the brutal math from the cold perspective of the financial institution. Their debt payments have skyrocketed because of the massive refinancing wall. Their insurance premiums are completely through the roof. Their property taxes are higher than ever before in history. Their profit margins are suddenly under severe existential threat. Do you think that these massive institutional investors are going to absorb those massive losses out of the goodness of their hearts? Absolutely not. Every single cent of that vastly increased financial burden is being calculated by their pricing algorithms and baked directly into your next lease renewal. They are going to ruthlessly squeeze every drop of capital they can out of the renter class to ensure their immense debt obligations are perfectly met and their profit margins remain intact. This is the new reality of the housing market, a system rigged from top to bottom against the people who actually need a place to live.